You mentioned CD. For our younger listeners or viewers, that stands for compact disc. Um, they existed back when the dinosaurs did. So
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my two colleagues, Dan Weiss and Nathaniel Leach. And today we're going to talk about quarterly updates. Who would have guessed we don't have a guest today? We have a couple fun topics to talk about. The first is inflation and rising rate concerns, which has to do with the Federal Reserve, the stimulus package, printing money. You know, that's a very hot topic. We're happy to discuss it. We're going to talk about the most recent stimulus package, what that entailed. We have NFTs on the board today, non-fungible tokens. But we're going to have Dan drive the ship. He's going to ask us some questions. We're going to talk about it. We're excited. Here we go for quarter one of 2021. Let's do it, Dan.
Getting right into it, let's start talking by probably the largest one we've heard for the last number of months, but really picking up some steam is, like Tim said, inflation and rising rate concerns. So it was just last month that the Fed came out and said, hey, we're a long way, quote, away from getting our goals for this economy in a comfortable spot. So we have no intention of raising rates or reducing bond purchases. So let's start there because we've heard a lot of discussion about this. Tim, usually you're right there with me when these questions come across. Can you talk a little bit about, well, let's start with where people maybe are fearful and why, and where that's coming from, and what they're afraid that they might see coming down the pipe here soon. And then we could talk about what is factual from what the Fed is saying and how that relates.
Sure. So I'm gonna make an edit to your comment that people have been talking about this for the last 3 to 4 months. They've been talking about it for the last 10 years, almost 11 years. Because this conversation, I can remember talking about it when I was in school in 2008 about the Fed bringing interest rates, starting quantitative easing. It's never happened before. We're going to be printing money. The package that the Obama administration put together, people said that was too much money. So this conversation has been a conversation and a conversation and a conversation. And what's interesting about it is that there's a lot of differing thoughts and there's a lot of ways to approach it and how to analyze it and see what's going to happen. Now, the difference between 2008 and today is people thought back then we printed too much money, did too much quantitative easing. And then you had the pandemic. And then the Fed and the government, so the federal government, put fiscal spending together, tie those two policies together, and we printed some money. So now people are wondering, okay, we printed too much money supply, which then potentially can create inflation. If inflation gets out of hand, that drives up interest rates, which then interest rates go up. That means all of a sudden you typically have a slowdown of borrowing, so less spending back in the economy. If interest rates go up, typically speaking, you'll see inflation. The Fed is targeting inflation, so they're going to start, tightening on the economy to then not make it too hot, right? You always have to remember they don't want too hot, too cold. They want the middle porridge bowl. The middle porridge bowl, based off of their new definition, is 2% long run inflation. So they made that adjustment, right? And it's a really important way that the verbiage of that is that they want to see long-term inflation at 2% on, I don't know for sure the verbiage if it says average, but they want that metric. And what they're going to say recently is they said, I think this was actually in like March, it was either March 10th or March 17th when they had the conference call with Fed Chair Powell. And he said that we are going to see a transient inflation number. It's going to move above 2%, but we are not going to back off because we feel like it's going to come back down and then it's going to even off up into 2023. So they're willing to allow inflation to go above their short, like in the short run, 2%, to then average out a 2% long-term inflation rate. So that then again, and they're not backing off on bond purchases yet either. So they're still pumping a lot of money into the economy. And then, as we all know, our recent bill was, I think, valued at $1.8 to $1.9 trillion. Put all that together, that's a lot of money. So what people's fears are is that we're going to have inflation. Inflation erodes the value of the dollar. It, again, stops borrowing, like I mentioned. And so it becomes really, really difficult. I mean, people at a younger age, if they're looking to get a house, I saw a really interesting slide deck about homes, and this was specific to the state of Utah. And they were saying that people will start getting priced out as interest rates hit 4%, where people will stop being able to afford home purchases because of the overall payment. Now, that's specific to a state, but I'm assuming if you looked at that across the United States, what happens is people start getting priced out of being able to buy homes, right? You start slowing the economy down. And when you slow the economy down, that's when you potentially can create recessions, depressions, and so on and so forth. So it's always a balancing act with the Fed, with the government, to try to figure out how hot or how cold the economy is and do their best to continue to do that. Now, the debates are either A, yes, we're printing way too much money. We're going to have hyperinflation like we saw back in the, I think, what was it, the late 70s into the 80s. And that's just going to extremely increase. Or you have the other debate, which I know Nathaniel's there, more of the people who are in the campus saying, no, we haven't spent enough into the economy. We have the slack. We have the ability. Inflation's not there. We should continue to do this. And then you have another debate that people say that because of technology, we have deflationary pressures. We don't even have inflationary pressures, right? So there's a lot of different ideas or perspectives if you really start reading into it of what can and could not happen. And I think it just depends on what camp you sit in, what camp you think is going to happen. I can tell you that a lot of the fund managers that we use within our portfolios, they talk a lot about inflationary pressures and watching for that and looking at different investment theses based on that idea because of the amount of money that has been printed, not just in the United States, but globally. So it really just depends on one's perspective. And I can tell you that if we had the crystal ball, this wouldn't be a conversation. If someone had the answer, it wouldn't be a conversation to be had. So it's very subjective, and it depends on what economic thought process you want or lens you want to apply to the problem, even if you see it as a problem.
People's concerns or being fearful about such a concept, the fear itself is understandable. Rising rates mean that getting loans is going to cost them more money, and there is a threat to finding ourselves in recession. That makes sense. I want to talk about then a little bit about what the impact is if indeed we don't see rates rise in the near future. But before I go there, I'm going to pause for a second. Nathaniel, did you have any other thoughts or comments you wanted to share? Well, he does.
Yes, I do. I have multiple thoughts. So going to the fund managers concept, point that Tim made, what I like about the fund managers that we invest with is that they are looking for companies that can do well in most any type of environment. So I too follow the same principles in the sense that I'm typically looking for companies that can do well in either an inflationary or deflationary or any type of environment, because the types of companies that we gravitate towards are companies that have pricing power. Typically, those are the kinds of companies that we generally like because those companies generally do well. It just so happens that we happen to be positioned such that we're invested with a number of companies that are either relatively asset light, so they don't have to expend too much capital on physical infrastructure. So as a result, and they typically have pricing power with their services and products. So such that if it was in an inflationary environment, for example, they'd be able to raise prices accordingly. They don't have to spend money to put more infrastructure on the ground. So it works to their advantage. And then we're also invested in companies that do have a number of physical assets, and they have a lot already so-called in the ground, such that they will be in an advantage also in an inflationary environment, because they've already spent the money and now it's just about maintaining during that particular environment. So that's just an example of, I'm sure that those fund managers that we invest with are thinking along similar lines. Also, I think that it's to those three scenarios that Tim laid out. I think it's going to actually be a mix of all three. I think, for example, that technology is deflationary, but just technology. Excuse me. I'm sure that there's other things as well, but not everything is in a deflationary phase. On this opposite side of the coin, not everything is going to be in an inflationary phase. I think, for example, that we will see inflation in some commodities, particularly oil. I think that ever since the crash in 14 within the oil markets, that a number of the oil majors worldwide have stopped drilling as much because it was no longer economical for them. As a result, and especially after the pandemic, when things virtually came to a stop, that I think could potentially lead to inflationary pressures within the oil markets in particular. So that kind of play would most likely lead to somebody who has the acumen to then find companies that are, I would say, royalty companies, that are asset light companies within the oil industry, that is able to take a royalty stream of some sort. And no matter what the price of the underlying oil price, would still make a profit, because they're basically making money on the spread. And they don't have to lay out anything in terms of physical infrastructure to get those funds. They already have that physical infrastructure. So I think that it's a lot of different factors. I think that people like to hook on to one particular concept and say, "Oh, it's all going to be inflationary." No, it's a balance, people. It's a balance of inflationary and deflationary pressures. There could be some stagflation mixed in there. Who the hell knows? It's a balance of so many different variables that economists do their best to say, "Oh, this is what's going to happen." They don't know what's going to happen.
The only thing I would add to that, and I actually have one question for you, Nathaniel, but to add on to your comments, I think that we also are in a very different stage, and I hesitate to say it because, right, I don't want to say that this is a new economy, but I do think the United States is going through an economic shift from a job perspective. I think the technology companies and the service companies that are becoming more of the powerhouses within our current economy, it's different. It's not as much of manufacturing. Manufacturing may come back over potentially, but I think there's a lot of difficulties to get that to happen. But the reason why I say that is I've heard some different people make this comment, and I like it. And it really is to kind of help with potential wage inflation, the wage pressures, the inequality that we currently see within the United States. It's an education problem. And it's the retraining of individuals to be able to get them back into jobs that are more sustainable. And I think that's a really interesting comment, and it takes it a different approach. And it potentially could help with some of these potential inflation drivers, right? Because it's all about production and consumption. And that's really what it comes down to. But it's just interesting. And I just wanted to add that one comment. But the question I have for you, Nathaniel, is if interest rates were to increase, talking about fears, what does the valuation of the market look like if the treasury bills become 5, 6, 7%?
So what happens when interest rates rise? Oh boy. A lot of things can happen. So that report that you, or that thing that you found on Utah, if the interest rates were to rise to 4%, I don't know if that's the entire picture, because what generally happens when interest rates rise is prices come down. So the house prices would probably come down. Now, there's no way of knowing how much for each interest rate up, how much the prices are going to come down. It's usually the result. The monthly payment is usually roughly the same. But in a market, there's no way of knowing what that's going to land on. So that's what would most likely occur, is that interest rates go up, prices come down. So that could be a detriment to people that may have taken advantage of low interest rates today when they were buying a home, but also simultaneously they might have overpaid for their home. So if interest rates were to rise, the value of their home would most likely come down. So if you're in it for the short term, owning that home, that might not be a good thing for you personally. So that's one thing. When it comes to stocks, same thing. Interest rates go up, stock multiples or valuations come down. Why is that? Because when you're looking at the capital structure of a company, what happens is that equity is on the lowest rung of the ladder in terms of if the company were to liquidate or be bought. I shouldn't say company be bought. If the company were to liquidate, the equity shareholders would be the last ones to be paid out, because it's the debt holders who are paid out first, and there's different levels of hierarchy there. And then preferred shares, which is above common shareholders, and then common shareholders. So the reason why I bring this up is that bonds typically trade at lower, an equivalent interest rate or return that is less than equities. So if interest rates in general were to go up, then those bonds with the interest rates that you're receiving may look more appetizing than equities, because the bonds are typically less risk because they're higher up on the capital structure than equity or common stock. So that's why common stock common stock prices come down as a result, because an investor wants to go for the bonds, which is supposedly lower risk than the equity. And then one step above, say, just a corporate bond, that's what I was referencing when I was saying bonds previously, are treasuries. The US Treasury is seen as the so-called risk-free rate worldwide. That is, that the US Treasury is perhaps the least riskiest, if not no risk investment available, in theory. Excuse me. One could make an argument that may not be the truth, but we're not going to go there. So when any investor looks to make an investment, they automatically look at what is my opportunity cost. That is essentially saying, what is my risk-free rate of return? And they look at the 10-year Treasury. So if that's trading at, I don't know what it is today, 1.92% or something like that today, let's say it is, then that's a pretty low rate of return in comparison to, say, I buy publicly traded stock. But if interest rates go up to, say, let's say that 10-year Treasury becomes 4%, then those equities no longer look as appetizing anymore from a risk-free rate of return standpoint. So, does that answer your question?
Nailed it.
Nice job wrapping up that question. Moving on, not, in some ways a very related topic. We have seen some stimulus, and we've seen a few rounds of stimulus. So we've had a couple questions as it relates to that concept, the last round. Would one of you mind jumping in and talking a little bit about, still pretty fresh, but about what we're seeing as far as stimulus as it comes through at this time?
Yeah, I'm happy to jump in and talk a little bit about it. I probably know as much as everybody else who's read all the articles about the stimulus package, to be very honest. Some of the big items that were part of the package was the $1,400 check for certain families and individuals to receive a direct check through a debit card, through a check through direct deposit from the U.S. Treasury. That's another stimulus to just help people get through. I believe unemployment was also extended. I think the eviction policy got moved to June. That was actually a really big piece of legislation because that could have been a different kind of part of the market that might have been hurt a little bit from just the standpoint of people evicting their current renters. That is a whole nother ball of wax. You had the child credit that came through this bill. So it's $3,600 for a child under 6 and $3,000 for children. I believe it's $3,000 for children between the ages of 6 and I think 17. You had a lot of the stimulus going towards the fight of COVID-19 and through just different vaccinations, different testing, just a lot of money that got poured into that. And they hopefully sped up the vaccinations to everybody having at least getting vaccinated by the end of May, I think is their goal, which was 2 months earlier than they projected. And a lot of that money was going towards that effort. You also had more stimulus going towards small business. You had more stimulus going towards schools, towards college education, or sorry, for college education, for high school education. There was built in there some debt relief, but it was for people who were defrauded within their college education. So it wasn't a bill that was going to forgive any loans in the means of just actual education. It was something that had to do with being defrauded. I'm trying to think. There was a few other things that were things that didn't get thrown in there that were trying to be passed was the increase in the federal minimum wage that did not go through with this bill. There's a few other things that we were trying to, I think, get passed that just didn't get passed. But overall, it just wasn't. I think the total bill came out to be about 1.8 to 1.9 trillion, I believe, is what the number is for this current bill, which it might be the last one, just based off of where COVID's moving within the United States. Who knows, though?
Daniel, that's pretty thorough. Anything to add to that?
I do have something to add, but I worry that people might think that, oh, I'm all about capitalism or something like that.
Don't they already think that?
The case. Well, I hope that they think I have a people side. I do have emotions, I just wanted to bring up that the point about the evictions being delayed, that there are the landlords. What about the landlords? And I'm not talking about the big commercial operations that own a bunch of residential housing and they can survive. I'm more concerned about the landlords that the average Joe that owns his own home and then bought another property and rented it out. I'm concerned about them because there hasn't been any legislation passed to protect them. Like, for example, what is it going on with them and their relationship with their bank that owns the mortgage? They probably got to work something out there, but there hasn't been anything legislated to protect them as has been done for renters. So I just wanted to bring that up, that I think that's going to be something that's going to, I bet the banks are making a deal with them right now, but at some point those homeowners, those investors are going to owe the bank for those deferred payments. And how is that going to be worked out? Like they're going to have to make more money. Like how it's, that's what I worry about.
You animal. No, I think you drive a really strong point there that just doesn't, I think, get exposed. The realities, and I don't know what the statistic is, the breakdown, but I'm sure that there's a lot more people in that situation than what most people think, where they own one property, maybe a house they used to live in and they kept it, and or not. I can see where you're coming from on that, because when we talk to people about buying other forms of rental real estate, we tell them to look at it as a business, because it is. And so there has been some help for businesses, but not in that case. And in all reality, they have to put food on their table as well. So interesting take.
The reason why I brought this landlord piece up, though, in particular, was that it's just one example of that not everyone is being served by these stimulus bills. And I'm not saying that that should be the case. I'm just saying that it's something that we should all be aware of, that there will be winners and losers here. And we just have to be comprehensive of that. That's really what I want to point out.
It's a good point. Let's talk about something that's more fun. Let's talk about NFTs. They actually, in some forms, arguably have been around since 2012. But I mean, honestly, up until a matter of months ago, I don't think I really saw people talking about them. And now they're kind of the buzz of the last couple weeks. God, we've seen a lot of buzzes of the last couple weeks over the last couple years. So why don't we start with so non-fungible tokens, as Tim mentioned earlier, NFTs. Why don't we talk about, WTF NFTs? What is an NFT?
Well, I mean, the best way to explain an NFT, where's the original Mona Lisa? It's sitting in Paris, theoretically, right? I believe. So it's the original painting of the Mona Lisa. An NFT is an original meme, video, something that is digital that has a certain code that classifies it as that original. It becomes an art piece, a collectible, something in that nature that then can be traded back and forth for dollars or cryptocurrency or whatever it may be. I look at it as when I was a kid, I liked to trade baseball cards. I really liked baseball cards and I'd collect them. And I try to find the ones with the autograph or the CD. I remember I had a Ken Griffey Jr. I don't know if it was a rookie card or a golden glove card that was a CD, and you could put it in your computer and it like showed you stuff. It was super cool. It's like a very interesting card, but it's stuff like that. But instead of it being tangible, it's digital and you put a mark on it. I believe there's some I think it's meme faces that have gone for a ton of money. It's like a website where you can have like your own like emoji that you can purchase that's yours. So I think that the idea of scarcity, supply and demand, it's very simple. You have one of the originals and you have a bunch of people that want that one original, and that drives price. It's an NFT in a nutshell. And I know the coding and stuff, and there's background, and it's using, whatever code or certain program to back it up and make sure it's there. But to me, it's, you're buying the Mona Lisa that's online, and that might be cool for some people.
You mentioned CD. For our younger listeners or viewers, that stands for compact disc. They existed back when the dinosaurs did. So you talked about a couple different forms and this came up in the last couple podcasts we've had too, particularly the one we talked about with Jonatas in regards to art, which I think is a great example here. So there's many different forms this can take. I mean, it pretty much can be applied to a lot of different forms. Blockchain has been pretty critical here. How does blockchain fit into the NFT picture?
So the main principle behind who has ownership of an NFT is the proof on the blockchain. So the blockchain, for everybody out there, everybody knows about blockchain because of Bitcoin, in the sense that there's a bunch of miners who are mining Bitcoin, and the proof of who owns what Bitcoin is placed on a blockchain. And every time there's a change in ownership, another block is created that shows that ownership exists, and all of the other ownerships. It's just a recopying of all the information that's already known, plus the new and subtracted records of ownership. And that's the blockchain for Bitcoin. It's the same concept for the NFTs. So, and if you own an NFT, you will have proof of ownership via blockchain. So it has some I think that's very appetizing from the point of view of an art owner, because when it comes to ownership in the art world, there's always these cases that you're hearing of, oh, it's been proven to be a fake, and that art owner thinks that they'd had the original or something like that. The NFT circumvents that risk to an extent. From what I understand, uh, there's some technical digital know-how that one should have when they own an NFT to ensure that they maintain ownership. I say this because with Bitcoin and other cryptocurrencies, the entire chain of custody, so to speak, is not 100% secure. There were God, I don't know, what was it, 5 or 6 years ago? There were a number of high-profile news headlines where custodians of Bitcoin had been hacked, and the Bitcoin was stolen from people. So it's not 100% fail-safe, and I would argue that the same thing goes probably for NFTs. So buyer beware.
Great explanation, Nathaniel. I mean, so clearly there's some level of value in NFTs from that, the authentic verification of things. Where else would we say we'd find value in NFTs? Is that all it is?
I'm going to use Jonatas's overall opinion here and say, what makes history creates value.
So eventually they'll run out of firsts, I think, or they'll have to get really extreme on creating first. But then again, people have been creating art since time, so maybe I'm wrong about that. Who knows?
And it just goes back to supply and demand. It's a scarcity play, and if there's one original and there's 100 people trying to go after that one original, it's just like in an auction. It's like a live auction. I'll bet 500, 1,000, 2,000 in until someone goes, yeah, I'm not paying for that much for that. And then that person wins. At the end of the day, it's just a simple supply and demand, conversation. And then the question is, what is going to create that supply or that demand? What is it? Even Gerard, one of our team members, was showing me NBA. I think it's like NBA Top Shot or NBA. I can't remember the name of the website, but essentially they take, videos of NBA's, like, so for example, Giannis with the Milwaukee Bucks, block somebody's shot. And it's this original video that you can buy, and somebody's paying like 200 grand for it. And then if that also, that one piece of, I guess the one video that has their jersey. So if it was like Giannis's jersey number tied to this video, it goes for even more because it's tied to the jersey, which again goes back to me just thinking about trading baseball cards. It's just, that's what people are looking for and what they want. And if you have the original signed Willie Mays baseball, that's worth a lot of money because Willie Mays was a wonderful baseball player. Or if you're looking at Babe Ruth, or so maybe some artist creates a certain meme or digitization of some sort of art, and it's this one original, and people love that artist and they want that original piece. They have the potential to own it. What's interesting about all of this is that it reduces barriers to entry, right? The barrier to entry here potentially is money, but everybody might potentially have access to it. Where if you want to go buy a really fine art piece, it might be very difficult just to be in the group to be able to have the option to buy it, where this opens kind of the marketplace up to the general public as well, which is a really interesting concept.
That is.
Good or bad?
In close, I really enjoyed that both your comments on that last piece. I thought they were very insightful. I just don't. I think that like baseball cards can have a very strong significance to somebody's life and thus create value. So could art. So could a number of different things. I don't think it's really necessary or important or anyone's business to judge where someone sees value. I think where someone sees value, that's, value is in the eye of the beholder. Price is not, but value is. And so, if you really love that art, if having that original, the ability to say that I've got the original feel to this is important, then fantastic. Where I think people could go awry is, in most cases, if then the attempt is to try to turn a profit on it. Because once you attempt to do that, you're no longer the beholder, because you're looking to make someone else that. So really value sits in their eyes, which makes you subject to that issue of price that you are not controlling. So just understand what I think your intentions are there, and and prioritize those correctly. Tim?
I liked your thoughts, by the way, Dan. They're great. I think I'm going to talk about the inflation and interest rate conversation. And I'm going to pick from one of the things that Nathaniel mentioned about some of the mutual funds that we use and how they prepare themselves for either inflationary, deflationary, pressures in the economy, right? They're buying companies that can survive or can maintain through different types of economic assumptions and trajectories. I think that individuals can have the same approach to the economy. It's way too hard to anticipate or to know if mortgage loans are going to go skyrocket to 12. Just as hard as it was to know when they were at 12 to 15% that they were going to come all the way down to 2%. But what you can do is you can position yourself to be able to take advantage of those opportunities if you can. And the way you can do that, for example, is Nathaniel mentioned, as interest rates go up, prices come down. So if you go and you buy your home for 3% down, well, then you can get yourself in a potentially really sticky situation. But if you come in and buy that house with 10 to 15 to 20% down, you can protect yourself from that, right? There's different ways that you can start protecting yourself for the unknowns or for the assumed variables that you may be inputting into your projections. And so just as much as people can analyze or companies can, fight for inflation or deflationary pressures, individuals can position themselves for those unknown economic factors as well. But it's just optimizing and operationalizing your overall finances, which means you have to know the intricacies of what you're doing. And that's really what the core of financial planning is you can't know everything, but what you do know is you have all the information today. It's very similar to poker, right? You have the information for each hand, and you have to make the best judgment or best call based off of the information given. You're playing poker every day with financial decisions because these variables are unknown. So you can either have analysis and have paralysis, right? And just say, I'm not going to make any decision. Or you just can become less outcome biased and make the best decision given the information that you have today. And if those information changes, then you change your decision from there. That's the best way to be able to kind of fight through some of the difficulties of knowing where the economy or where things are going to go. And that includes recessions and a bunch of other aspects of, an individual's financial life. So I really enjoyed Nathaniel saying that, because I think you can apply it directly to financial planning as much as you can investing in companies.
I think I said enough, honestly. I said more than I thought I was going to say. So I'm just going to leave it at that. Great job, guys.
No, you were criticizing us for going too long.
I stand by that statement. Yes.
Well, then we'll just take a moment here to thank all of you for tuning in and hearing the three of us talk about a number of subjects that we love to talk about, and appreciate you giving us the opportunity, as always, to provide some insight and some education. Until later, have a great night.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time,